All right, good afternoon, everybody. This is Event Trader. I will be joined here shortly with Brett Manning, chart trader. Brett, you with us?
Sure am, Gav. How you doing?
I'm doing good. How's your day going so far?
Pretty good.
Okay. I mean, it's been about 2 weeks, I believe, since the last time we met. It's funny because in those 2 weeks, while the market's gone higher, I don't think really too much has changed. But there's a few things that we've been looking at that are definitely sticking out to us. Not enough to get us all out bearish by any stretch of the imagination, but something that definitely bears watching, particularly on the options front. And we'll get into that. But for right now, the 30,000 foot overview from where you see the markets right now, Brett, why don't we break into that first?
Well, I think that the basic idea and the sort of conceit of the contextual bullish perfect storm is very much in place at this point. It continues to drive the narrative, and again, that's made of a couple of different pieces. I don't want to consistently rehash this, but I think it's important to note, where you have your contextual boundaries. We have right now the first time in history where you have the ECB, the BOJ, and the Fed all expanding their balance sheets at the same time. And we have a lot of fiscal stimulus around. Just look at U.S. deficits this year, in a year where we see outperformance economically, and we see the stock market, consistently racing at all-time highs. We're going to post an all-time record deficit. So there's your fiscal stimulus here. There's a number of different forms of it. The tax reform bill is still, to some extent, in effect. Certainly a lot of it in Japan, tons of it now in China. Obviously Europe continues to have a problem in implementing fiscal stimulus, but basically we have paired up fiscal and monetary stimulus everywhere in the world, despite what looks to be some sort of asset bubble in the making.
And with China in mind too, Brett, I would just remind people tonight or tomorrow morning you should expect to see China once again cutting their 1-year loan prime rate. They're expected to cut by 10 basis points to 4.05%. It's currently at 4.15%. And earlier in the week, Brett, Mexico cut their rates, and that became the 800th interest rate cut since the Lehman bankruptcy.
Yeah, I saw that, right.
But go on. Sorry, I didn't mean to interrupt you.
No, so we've got the context in terms of stimulus in place. We have the context in terms of comps coming into place where, and I've outlined this a number of times, I'm not going to go all the way back through it, but basically, the brief point is we're going to have probably an unnaturally low bar to jump over in terms of year-over-year growth numbers for individual equities, individual companies, and the larger economy in Q2 and Q3 of this year for a number of different reasons. But the market is trading in front of that. So it's trading in front of a kind of easy-to-pass exam. So it's a little bit easier for it to weather something like the coronavirus situation, which amounts in some respects to pulling forward stimulus and postponing demand. And that paired up situation in a low inflation environment means you get a single whammy and then a double whammy. And the double whammy happens in concert with the easy comps. So that kind of forms along with the stimulus sitting in place. So more stimulus is pulled in because of the threat. And without inflation, that stimulus is not going to go back out. And we're storing up a large coming release of pent-up demand, which is around the corner as we get past the peak in terms of the infection rate, the rate of spread for the coronavirus. So we're kind of moving into this next period that's going to be easy bars to jump over, more stimulus into the picture, and an explosion of pent-up demand all at the same time. And so it's going to be tough for anything to stop this market too easily. One of the things that I'm looking for maybe is a little rotation, because as we get past that sort of peak point in terms of the threat of escalating second derivative impact of coronavirus, I'm still holding on to the idea that we're going to start to see some more cyclical areas play a lot of catch up and maybe see a rotation from some of the less cyclical areas. But we haven't seen that yet. That's sort of an around the next corner view, and I'm kind of flirting with it a bit. And then the other thing is what I think is a philosophical shift in at least the Fed and probably other central banks invading the culture of central banking right now, which is effectively, and I think we're going to look back on this years from now and say November 2019 is when we change the platform of what the Fed does. It's been subtly hinted, but I think the idea essentially is that they're no longer really going to try to be ahead of the curve. They're going to wait until inflation is manifestly a problem before moving. And that's very different from the world that we've seen since really the late 1970s. We're talking about a large paradigm shift in, I think, one of the fundamental assumptions that drives people's expectations of Fed action over time and will probably impact Fed funds futures over time because of the way the Fed has started to message around the idea that they're not going to hike on strong data. They're going to hike on inflation and inflation above basically where their threshold is going to be, which is probably higher than where it's been in the past in practice, even not if in language. So that combination, we're seeing more stimulus from both barrels. We're seeing easy comps coming, and then we have a new paradigm at the Fed which suggests that stimulus is less likely to be taken back no matter how good things get. And I think all of that is making the Fed or the market very resilient in the face of some potential macro negative catalysts. So I think that context is still the case. On the sentiment side, the question is, when do we start to get over the skis, even given all of that, which will unquestionably happen. And, we'll talk about that as we go through individual data, but I think that's the context that we start with.
Yeah, and that's exactly where we line up here. The two big underlining themes for me is the idea, too, that most people continue to view the coronavirus as a Q1 event, although I was interested to just see this GE headline where the CEO, Lawrence Culp, said that second quarter is where the supply chain challenges are likely to manifest themselves. So I'm curious to see a little bit more of the context of that comment, but definitely something that we'll have to continue to watch. Just anecdotally speaking, Brett, I was talking with some neighbors who had just gotten back from Thailand on a trip, and they were talking, they were on their plane to fly back, and all of a sudden their plane got halted, and some officers came in from Thailand and took 30 people off the plane. And then they had to fly back to the U.S., where they were greeted by about 20 customs agents, and everybody had to have their temperature taken and everything, checked out to make sure that they weren't transmitting any sort of virus. But of course, we know that there's a 2-week incubation period too. That might not get detected, but that's just like one anecdotal evidence of what kind of impact the coronavirus is just going to continue to have until.
Let me insert something. So let me be clear. Everything I just said, may be wrong. Like, people may be wrong about it. I'm trying to characterize, I think, what's causing the resilience that we're seeing in the market, but it's very possible that the facts on the ground will change that.
Yeah,
so,
exactly.
I think it's reasonable to think that this could be a bigger deal with more dominoes to push over.
Right, and that was the point of my comment there, just to kind of discuss how the market's trading as this is a one-time event. I mean, we've seen multiple companies come out, Apple, Nvidia, when, of course, all warning about Q1 results. Apple being the most high profile, but Nvidia also lowered theirs, and we see that hitting all-time highs. So it's been pretty obvious that people are ready to shake off any impacts from the coronavirus. And it's funny because that's one of the things, and we'll get into it a little bit more, on why the Fed thinks, or why most people think that the Fed is going to cut rates. So that's something that we're going to need to discuss a little bit more in detail. And the other thing that I think is factoring in a lot here too is the growing sentiment that the most likely winners of the presidential election are going to be Trump and Bloomberg, where Bernie is leading the Democratic Party and would certainly seem to shape up as a negative for the markets. But most people definitely seem to continue to be in the mindset that if he gets in that position, that Trump on a strong economy will be able to beat him. So I think that also factors in to some of the sentiment reading that we're seeing, and I think that's their two key underlining factors. But I do find it interesting with all that in mind, and obviously the points that you've been laying out for the last couple of months here, Brett. The Fed funds. Let's take a look at that first, and because I find that to be pretty interesting right now. We have seen expectations for a Fed rate cut move from the average overall rate moving from about 15 basis points at the start of the year to more than 40 basis points now, meaning that when we
Over
started
what
off
period?
over
Oh, you mean
29 over
at some point
2020.
this year? Okay.
Over
Yep.
2020. So basically, at the start of the year, most people were leaning towards the next step likely being a cut at 15 basis points, obviously, on the south side of a 25 basis point cut there, and that has moved to 40 basis points. Now, with those expectations, 60% of them believe that there's a chance that the July 29 meeting
Yep.
will be where that cut is made. So it's not over. What is it? The threshold usually about 70% before the Fed generally moves.
70% makes it a guarantee, and the Fed knows it, so they would jawbone it down. So
R-
70% is effectively a guarantee of a rate cut. But this is a volatile number, and that's a ways out. So
Right. So I guess the point that I'm making, and as you said, it's a ways out, but um, I think one of the things that it was most interesting for me on this was the timing of it, that July 29 meeting, which if it was the coronavirus, that most people, and that seems to be the key driver for why people think that the Fed would move. Why would it not come till July? And I find that to be interesting because if you start lining up everything too, that also really gets the market's full attention. That'll just be about August 1, and we will be 3 months away from the presidential election. So I wonder how much
I got a
that,
theory.
what's that?
I got a theory.
Well, let's hear the theory because I'd like to hear this, and then we'll just talk about some of the Fed comments that we just saw across the wires from the latest minutes.
By that time, we will know that we won't have a vaccine for next year's season.
That's fair. That's fair. That certainly adds up because a lot of the things that I've been seeing is that it would take them about 6 months to incubate to create a virus for it, and that would land right in that time frame for sure.
Right.
So, but then when you're looking at the Fed commentary from the minutes, I found it to be a little bit more upbeat. So, the key line that was jumping out to me was FOMC meeting saw distribution of risks to economic activity as somewhat more favorable than the previous meeting. So, obviously, an improvement in economic events, but that also comes. Now, this would have been the January 28, 29 meeting, so it would have been about 4 or 5 days into the coronavirus. And they did address the coronavirus in it, where they said that they would be watching that a lot, that it warranted close watching. So now, do you think that's something that there's an uptick in the Fed concern around the coronavirus over the past 6 weeks, or over the past 3 weeks, I should say, that perhaps the market thinks that they're pricing in right here?
Well, I mean, I hate to throw it in because it sounds, I mean, in the world that we live in now, I don't know if it sounds as bad as it would have 10 years ago, but also the dollar is a little bit, it's getting to the point where it's going to start to become a front page headline. So,
Some tweets coming on the strength, you figure?
well, it's not just about what the White House thinks of it. It is a real thing, and
Right.
it's starting to get a little intense. And I think that the way that the dollar tends to impinge itself on policy and a lot of different ways of trying to take control of the steering wheel. It's usually nothing until it's something, and when it kind of rounds that corner, it becomes a more volatile version of a rally. We start to get talks of conspiracy theories about a kind of behind closed doors global meeting of central bankers to try to stop it because everybody loses in a world of a runaway dollar trend. And we've seen some pretty dramatic stuff. And my theory has been in part that we're starting to see a little bit of what I talked about with the euro last year start to come to fruition as the ECB starts to lag, and now we have a sort of model citizen for the UK with the pound outperforming, and people starting to feel like, is it possible that in a down cycle, the UK is actually strengthened by exiting the eurozone, and is that going to set an example that causes existential risk in the euro? All of that feeds the sense of the dollar as a safe haven, but one with a kicker, and we're starting to see that a bit, and I feel like there's possibly some play in there as far as expectations of what the Fed might do in a world with still no inflation pressures.
Right, and with that, the dollar is off to its best start in 3 years since 2015, and moving up towards that 104 post Great Recession highs there. So definitely a strong dollar is something to watch, which probably makes the run in golds pretty impressive too. Because one would think that with the stronger dollar, gold would be seeing a little bit of a hit there. Obviously, people are still buying into it as a safe haven. You are long gold right now, Brett. So, what's your take on the gold activity we're seeing when you see asset classes across the board really running too?
Well, it's one of the things that makes me feel like I'm standing in the eye of a hurricane. Like I don't know if anybody. I grew up in Florida. If anybody's been, I've been in the eye of several hurricanes. It's a really eerie feeling. Like you feel, there's half a mile away from you on one side there's tornadoes, a half a mile away from you on the other side there's tornadoes, and it's a perfectly sunny day right over top of your head, but the air feels really heavy, and you feel like almost electricity. Sometimes the hairs on your arms stand up. It's a weird feeling. And when I watch gold and the dollar and the bond market take off to the upside at the same time as we're in a 1999, blowout mania in the NASDAQ, I feel that same kind of feeling. Like there's something has to give there because gold and the dollar don't move together to the upside unless something's going really wrong in the world. That's my experience. 25 years at this. That is just reality. Gold and the dollar going to the upside together consistently is something that does not happen when everything is great and people are optimistic. So I feel like that eye of the hurricane kind of feeling here, where there's just something that's not making sense, and it's eerie, and it's eerie to watch what the bond market's doing at the same time, and maybe there's sort of like an everything bubble going on because of the paired stimulus and the global nature of it, but the fact that the dollar is doing it in the midst, maybe there's just a strange circumstance where the dollar is more reacting to existential risk in the euro while we're having an everything rally in risk assets or something. I don't know, but the fact that we're seeing this kind of positive correlation between the dollar and gold and bonds to the upside at a time when we're also seeing that in a lot of risk assets is just, it's something I don't have an answer. I don't have an explanation that makes me feel good. It just feels strange.
It certainly leads to all the liquidity being pumped in by all the central banks looking for a place to go. And really, it's just everywhere. I mean, the ultimate rising tide lifts all boats, basically.
That plus, I guess, U.S. outperformance economically.
Yeah,
I guess.
And with that, we could pivot to the U.S. economy, where data has remained strong. We did have a little bit weaker housing numbers um, earlier today, but a lot of that was also viewed as pull through from December, just because of the seasonal warmth that we've been having. Be interesting to see how that impacts the usually hot season in a couple of months when we start getting those February and March reports, because there does appear to be a lot of pull through on that. Now, we did have the NAHB housing market survey fall a little bit short of expectations there, so that was certainly something of note. But on the flip side, yesterday morning we also had the Empire State Manufacturing number really handily beat expectations. So overall, economic data has remained strong. Just looking at the output and activity indicators, they're showing growth remain close to 2% annualized. Consumer spending saw a bit of an acceleration in consumption growth. Investment indicators also seeing a surge, particularly in residential investment. External trade indicators, they're a little bit lighter, not surprising given some of the global weakness. Labor market, of course, has remained extremely strong. Inflation, which we'll get into a little bit deeper, a little bit lighter. And then you got the financial market indications, obviously showing that financial conditions remain loose. But
I think the easiest ever, right? Didn't I see recently something essentially like the easiest financial conditions index scores pretty much ever?
I mean, judging from the amount of credit card mail I get in my mailbox, I would agree with that. Because
I mean, we were joking about Greek borrowing levels, months ago, and it's gotten easier.
Yeah.
Junk bonds everywhere, easier, everything easier.
Yeah, and it's really interesting too, because like you see now, there was the first ever purchase of a bank by a fintech company. I don't know if you saw that, Brett. Lending Club bought a small internet bank with only about 1.4 billion in assets, but
Is that a
he,
diversification move
it's
or integration?
that basically they're just buying it for their deposits. In order
Oh, okay. All
in
right.
order to create a bigger base of liquidity for them. That's going to be the key. I think you're going to start seeing a lot more fintech companies with the massive rally we've seen on the tech side. Look for those deposits and those safeties in order to boost up their balance sheets. That's how I look at that. But
Makes sense.
with the U.S. economy, though, in general, curious to see. Obviously, Boeing's going to be a big drag on the GDP. I've seen it. People looking at uh, the slowdown in orders expected to knock off as much as 0.5% of GDP. And then we got the coronavirus. So if we start seeing weaker data, do you think the market's going to just rally on that, on the idea that, okay, here comes the rate cut, or do you think we start seeing a little bit more of, okay, we're nearly at 20 times a multiple in the S&P, I'm going to start squirreling away some of these profits?
Well, I mean, I think that everything that we're looking at here is a potential end of the party situation. Is right now is about whether or not people feel like they're able to continue to take risk, and I think that look at the coronavirus situation, just as sort of a lab rat example. How many people on the planet are going to be affected by that this year? Let's say we get up to 1 million in a world filled with 8 billion people. But the degree to which it can have an impact on economic activity is about how people feel, if they're willing to take risks, if they're willing to continue investing, expanding, moving about, consuming everything. It's about whether or not that the fear of the possible either it's exposure to coronavirus or exposure to business risks that will be impacted by the virus. It's just purely a psychological experiment that we're running through right now. And the degree to which you see things like some of the economic sentiment indicators and some of the measures of businesses taking risk. If we see something like the Empire Index tick up the way that we did, that's a sign at this point in the game that right now that confidence undermining process isn't having a game-changing impact on anything. And to the extent that that remains the same, and there's a second derivative aspect to this, there's an echo chamber, there's a common knowledge game. As people start to perceive whether or not people are continuing to take risks, it's probably going to be the way to isolate what's the most important variable. People see that other people are continuing to take risks, so we continue moving in that direction with everything until there's definitive proof that there's a major kind of tipping point that we've passed by, and we're starting to domino or pyramid in the other direction of constricting those risks, of turning toward risk aversion. It's a little bit like a miniature version of those turtles that we talk about, does the weather get bad as they go in their shells? And I think at this point, we will need to see some kind of proof that we're seeing a lot of people really start to pull back in terms of risk that's going to start to have dominoes through the system. And at this point, we haven't seen that. There's, just like you mentioned earlier today, there's this sort of one quarter, one off narrative right now, and we're late enough in the year, late enough in the flu season. Perhaps we'll have a vaccine before next year. We've got a lot of new stimulus. We don't have inflation. It all adds up, and I think we would need to see something come into the equation that starts to change that narrative.
Right, and with that, we'll transition over to the sentiment trader data here and take a look at some of the things. But just when you talk about that coronavirus to start off the sentiment, I think Nike is a perfect example of this, where we just saw Adidas come out and say that their production was going to be down. I think it was something like 85% in the region, and yet you don't see any reaction in Nike at all. Nobody wants to jump out of the boat yet. And again, the sentiment survey has definitely kind of pushed that. So when we're looking at the overall reports that we follow, nothing fell, not surprisingly, in the excessive pessimism range. I can't remember the last time I looked, and there wasn't anything with at least one dot filled in there, Brett. But we are starting to see a pretty more extensive collection on the excessive side of things. And the one that continues to jump out, and we were talking about this yesterday, is that robo put call ratio, where we're seeing people pay up at a premium for calls, and nobody's looking for hedge protection here. So, looking at that, you also have the option spec index, which I was seeing that at an all-time high. I could only read back to 2000 there, Brett. I don't know if you have more data on your side of things, but really interesting to see this call activity given the levels that we were at.
It is, and it's extraordinary, and it's one of those eye of the hurricane kind of things too. So the option speculation index is nowhere near an all-time high. If you go back to 2000 or very early 2000, it was considerably higher, but it is the highest that it's been since '99 and 2000. But to throw it in, you've got the robo ratio, you've got the option speculation index, and you've got just looking at 10-day average of CBOE total put call. You're starting to get to that kind of difficult zone around zero point 0.8 as a 10-day average for closing prices, and that tends to be a little bit of a danger zone. We were actually a little bit under that in mid-January, but first time in years we were down there. So the persistent sense is that the options market has changed, and we talked about this last time too. I don't want to jump the gun at trying to. First, I'm not going to start selling my investment book because of what options data is doing now. And in other environments, I might want to do that. In this environment, I'm starting to feel like the options market is becoming a less reliable input for sentiment data, precisely because we're starting to see a lot of people, I believe, who haven't been as involved in the stock market start to get more involved in the stock market and use the options market rather than as a hedging market, as a speculative way of purchasing access. Yes, they're levering up smaller accounts, and that eventually gets to an unsustainable point. But initially, I think it skews what you might think of as the benchmark levels. So I think the benchmark levels are moving a little bit, and that's why all of the options data that we look at as sentiment data is skewing toward extreme exuberance, when a lot of the other data, things like the surveys, things like hedge fund exposure, things like the term structure, they're not really confirming that right now. It's just everything related to options, and especially the robo ratio. If you look at the lobo ratio, it's not really in extreme territory. It's
No,
flirting with it.
Yeah, it's flirting, but
Right. So the larger options trades by more professional traders are still sort of a little bit in a normal space, but you're looking at the smaller options trades, and you're looking at something like the speculation index, and you're looking at the 10-day put call overall. I think that's starting to show that we're seeing people come in and use the options market really as a naked exposure vehicle, and you're going to even out more in terms of demand for calls. It's just going to stack things in that direction, because most people in naked exposure are longs in the market, 90 to 10 basically as a ratio. So if people start to use that more as a way just of participating in the market, I think that given the long side bias nature of participation in stocks, generally speaking, you're going to see all the options ratios skew in a way that may be a little bit misleading if you're looking to use it as a basis to say, where's the point to start throwing in the towel on this?
well, I think one of the items that was jumping off the page to me too is hedge fund exposure. It's starting to get in excessive optimism areas, but they seem to still be pretty underexposed to this. And you were just talking prior about people looking to chase into this market. We've certainly seen plenty of passive managers outperforming active managers, and we start seeing areas where we could see a further blow off top that's making it so difficult to short things here. Certainly Tesla has been a name that people have been jumping on and just really piling into it to the point that it's just pushing everything higher. And when you look at this hedge fund exposure, that's another area where I could definitely see further upside, despite what most people would look at as a parabolic run to start the year in the face of some potentially negative news items.
Do you see the yen today?
I did not. Did not take a look
You
at
should
it.
take a look at the yen today. it's getting crushed. I mean, off a cliff.
Huh.
Yeah, just cue it up.
Um, do you think that's because I know that there's been a lot of concerns about the virus spreading over there?
I
Um,
think there's a little bit of that, but I think there's a large amount of money, particularly in the hedge fund community, that has been strategically exposed to certain points to play the other side of
the carry
this
trade,
situation. And yeah, I think this is capitulation
the
from
unwind of the
hedges.
carry trade,
I think we're
basically.
finding where the hedges were, and they're going out the window. And I would imagine that's probably disproportionately in the hedge fund community. So I wonder if the net effect of the move we're seeing in the yen right now is a little bit of give up on, because yeah, you're right, the hedge fund exposure level. So we track this through looking at a comparison of something like the S&P with the HFRX, and so the hedge fund tracking indices, if they tend to do the same thing on a day in day out basis as the broad stock market does, you really know that generally speaking, the hedge fund community is exposed uh, by and large long the stock market without a lot of hedging. And we saw that, dramatically early summer last year. We saw that again dramatically in really around the sort of phase one trade deal period at the end of last year, and the move to new all-time highs in the S&P. And then we've seen it temper back quite a bit. And I wonder if, the Iran situation, the impeachment, coronavirus has kind of kept there being enough folks there where they've got a lot of long side exposure to stocks, but they've got some big hedging vehicles really engaged as kind of a black swan possibility of things falling apart. And I wonder if that side of the equation is just starting to give up at this point. Throw in the towel. We can't fight this thing any longer. And so I wonder if what we're going to see now, after we see this gigantic breakdown in the end, I wonder if what we're going to start to see is a lot more correlation there between something like SPX and HFRX.
All right. Somebody asking about the options spec index. This is all information that we take from Jason Gempert's Sentiment Trader website. So if anybody's interested there, I would check them out. All right. So Brett, let's take a look. Let's roll then into. We'll go take a look at the Bank of America flow show first, and then we'll peek at the fund managers survey, and then, time permitting, we'll talk a little bit more about the rotation and the cyclicals and value here. But both a flow show, not surprising, biggest weekly inflow ever into bond funds at 23.6 billion. Inflows to bonds are annualizing almost $1 trillion at Bank of America in 2020, but also a sizable 12.5 billion equity inflow too. And the equity flows annualized record are at an annualized record now at 443 billion. So as we can see, no surprise here. All we got to do is look at a chart, and there's a lot of money flowing into both bonds, both equities, and of course gold and the dollar too.
Yeah, a little bit of that eye of the hurricane thing again.
Yeah.
But to some extent, you are also seeing probably a large rebalancing influence on bond flows. I mean, we're certainly seeing people aggressively buy into bonds, but with the move in equities, you've got a lot of people who are what's called fixed weight managers. And when equities scream higher, they have to constantly manage their asset percentage allocation. So the value of their equities exposure, since equities are much more volatile than bonds, when the equities market is trending, you see a lot of moves in bonds in terms of flows, simply because fixed weight managers have to add more, subtract more, whatever from their bond allocation to keep it relatively even in terms of percentage. If they need to be, say, 70% bonds, 30% equities, and equities go up 20% in 2 weeks, they need to make some quick adjustments in terms of their allocation to keep those percentage levels. And I think that the dramatic move higher in equities so far over the last 2-3 months has led to a lot of confusion in flows that really has to do with the fixed weight component. But there's also, eye of hurricane. We're also seeing something real here. It can't be explained away entirely by that. And I'm not sure fully how to digest what we're seeing. Again, I don't have a grand theory for you, but I think that again, going back to seeing the NASDAQ positively correlated with the dollar and gold and bonds all moving together in kind of breakout style movement is extraordinary and certainly I think unique in all of my experience.
Yeah, I mean, how often are you going to see tech and utilities just blasting higher? I mean, I nearly fell over when I saw the XLU. I hadn't been paying that close attention to it. Obviously, a defensive sector there, but that's just ripped in 2020, breaking above 65 and rallying up to that 71 level. Seen a little bit of a pullback today, but certainly the lower rates having an impact there. But it's just amazing to see this rising tide lifting all the boats here. So,
Not all of them.
not all of them.
Well, I mean XLE. Look at,
Well,
you know,
yeah,
there,
okay.
there's certainly some
Yeah,
there's some traditional
oil.
cyclical components
Yeah,
that you would that there's a little there. I mean, obviously there's just so stories for all of these dynamics, but I feel like there's trees and there's a forest and there's meaning to the forest here, and I haven't put my finger on it fully.
right. Well, one other thing that I wanted to throw out from Sentiment Trader 2, and they had pulled this from the University of Michigan survey. I hadn't seen this, but 15% of respondents are 100% sure that stocks will rally over the next year. It's the most in 18 years of the survey's history.
Yeah, I
Like,
expect it to go up
yeah, yeah,
until it's done. Yeah, I mean, that's part of it. Like we're going from we talked about this 3-4 months ago. Saying essentially that we were probably given all of our data and the way that we're approaching this process on the cusp of seeing professional and retail go from underweight to overweight together aggressively. And that's what we're seeing. And so, yeah, there's going to be gradual markers, benchmarks, slashes on the trees that let you know you're getting closer and closer and closer to when this becomes a completely unsustainable dynamic. And it's just a process of, watching that happen. But we're going to see lots of data like that, I think, gradually start to appear. That
yeah.
eventually will suggest that, we have enough of available possible inputs into this market that are, as maxed out in terms of their risk acceptance, that it
Right, but
has any possibility of further extension.
I feel like a lot of the sentiment data has gotten there, but we need to see a lot of the inflows and hedge fund involvement get there too. And once we see that working a little bit more and lock in tandem, then we get that blow off top. But the, I think I saw Leon Cooperman say, and I completely agree, and certainly all the evidence that we've provided today, I think, supports the argument that we are in the early stages of euphoria, but we have not hit that blow off top that will kind of end this bear or this bull market right now. So,
Yeah, and I think that there's a marketing dimension to that eventually comes into play too.
yeah,
I mean, there's going to be a tremendous attempt to keep it going after it shouldn't be. And we haven't really, I don't think, seen that yet.
right. Okay, let's take a look at the Global Fund Manager Survey, Brett, from Bank of America. This was just released yesterday. So just taking a look, the risks, 2020 U.S. presidential election up at the top at 26%. Bond bubble pops at 22%. The coronavirus jumps in there at 21%. These are the three big tail risks according to investors. But it's interesting to see that U.S. presidential one number one, given that, just to throw out a number there, oddschecker.com, it's a poll aggregator, they have the probability of Trump or Bloomberg victory in U.S. presidential elections at a fresh high of 77%. So it's certainly interesting to see the idea that most people think that this is the biggest risk to markets, yet at the same time, most people don't technically really see it as a risk, because I feel like that risk is more to do with if Bernie Sanders or Elizabeth Warren got in. So how do you navigate those two numbers there, Brett? And obviously, even in some of the biggest blowouts that we've seen in presidential elections, be it Reagan and Dukakis or Obama, they both, even at times, were running a little bit behind in the polls. So do you see presidential polls, when as soon as we have a defined Democratic candidate, having a big impact on markets?
So I want to say a couple things. First of all, the risks this time in this particular survey, the dispersion is tight. So we don't have anything that people are very concerned about. Another way to look at it, when you see 26%, 22%, 21%, there's nothing that's like 62%. There's nothing that is something that people are really concerned about, but they have to have an answer, and it's probably multiple choice. So that explains some of, I think, what 26% of people concerned about that is not a great deal of concern. So that's one point. And number two, I don't think that it's the outcome of the presidential election that's the concern. I think it's the process. I think that we've never, ever, ever seen such polarization and such weapons of mass destruction on the campaign trail as we're going to see play out from now until November.
Now,
I think we're going to see things
if you
that are just nightmarish.
If you can't define a sample of a weapons of mass destruction, would you say?
I mean, okay, fine, I'll go there.
Fisticuffs on the presidential debate
I do
stage?
not know. I just a high
Would it be
level,
out of the question?
a high level PhD research level marketing and advertising deployed through well-funded social media campaigns targeting people perhaps without a great deal of education, saying things that are awful for the notion of a tension-free country.
Yeah.
So, I mean, the war that we're headed into, I think, just will dwarf anything we have ever seen in an election year, ever before, in terms of the scope and the depth, the penetration into personal household existence of a sense of there's absolute godlike angels battling against horrifying demons from hell. And whichever side you're on, switch the characters, but that's going to be the narrative. And we have such tribalism at this point, such echo chambers on both sides, that we have people who are living in realities that are completely separate from one another. And, you know, the internet makes it possible for you to communicate with people that you have pre-screened to share your bias and communicate with no one else.
Not even just the internet. I mean, geographically.
Sure, geographically. I'm a believer in...
I live in Chicago, in arguably one of the most liberal areas.
I know.
There's warrant signs all around and stuff. And, you know, you go around and then you go a couple miles out to my cousin's out in Wheaton or something like that.
I understand.
You see Trump
I think that's I think that that's a derivative characteristic. That I think that what we've created, and I don't want to go too much into this on this show, but I mean, I think that it's an issue because we have gradually created an echo chambering process that is so well defined and so pervasive in so many people's lives, where they really go through life. There's just two completely separate existences in this country: their perception of facts, their perception of everything, and their constant, you know, bandying about of the straw man version of the person on the other side is this ridiculous idiot evil person. And we've got both sides doing that to the other side constantly, every day, all day. And the billions of dollars, the billions of dollars that are going to be poured into this campaign are going to be designed 100% to foment that as much as possible.
Right.
So I think that's the risk.
And you're even seeing the centrists, like I viewed Bloomberg as a centrist. I'll be interested to see the debate tonight, but he's done 180s on a number of, you know, for instance, the financial transaction tax and stuff, just doing 180s just to appeal to his base because that's the direction he has to go. So
well, I mean, the political process is awfully difficult, and you know, but I just think the context is set up for the most contentious, most polarized, most, you know, just remarkable process between now and November that I think is going to itself, just in a process terms, itself presents a risk for how people feel in their daily lives, how they interact with the world, levels of consumption, levels of risk-taking, levels of borrowing, levels of lending. You know, all of these things I think are going to be impacted by the process that we're heading into. So if I were to put why the presidential election is a risk, it's not so much whether Bernie Sanders wins or one of the other two. It is the fact that we're going to see such a massive fomenting of this polarization that's already so dramatic. It's just tinder, and we're about to light it.
Thus, perhaps the July 29 Fed funds future
Could
results
be.
being read through there.
Yeah.
Okay, so let's break into some more of the fund manager survey bullet points here. Certainly some interesting ones. Global growth expectations. I don't want to say falling off a cliff because it's still net 18% stronger, but this was down from 36% in January. That's obviously a plunge in expectations of China growth, which went to minus 53% from 50%. I mean, that's just astronomical. Obviously, the coronavirus there. So
Yes.
no surprises in those numbers, right?
Oh, and that could be your best explanation for the Fed. The second biggest economy in the world is turtling.
Yeah.
And that is a point where they are watching, just like we talked about earlier. They are watching the people around them take less risk, which causes less risk taking, which is a feedback loop. And if that happens to the fastest growing super large economy in the world and the second biggest overall, and the one that is maybe the most important marginal factor for global growth, I think reasonable to say, if that economy is turtling right now, and maybe that's going to be more severe and deeper than we've known about, particularly if maybe there's been some strategic masking of the data on the spread of the virus there, then that could probably be your best explanation for the Fed actually being put in a position where it needs to cut further.
Right. Okay. So next thing we'll get into, and this will be a deeper dive. We're not going to have time to discuss the whole rotation theme here, but the deflation theme. Both Merrill talks about, and that's the combo of tepid macro, the coronavirus, oil plunging, which is offset by the QE forever consensus. But they're talking about a full capitulation into deflation assets, where they're saying the most crowded trades is long U.S. tech, growth stocks, big February rotation back into U.S. bonds, tech, and emerging markets. And this is all coming out of banks, energy, value, and the highest expectations of growth sectors to outperform value since July 2008. Now, I know we talked a lot late last year about how no one was positioned for the inflation trade, and we started seeing people moving away to kind of, I guess you could view it as a hedge, but certainly the last couple of weeks we've seen that hedge more or less be taken off the table from my read.
Yeah, and I mean, so the argument here is essentially that we're going to see a an acceleration of something that has been an anomalous, already predominant characteristic. So there being a barbell portfolio that is bonds and tech stocks. We talked about it earlier, and with the leaving energy out. So that's already been a theme. It's already been a powerful theme, a pervasive theme, and this, the fund manager survey here is they're making the case that we're going to see an acceleration of that theme into a kind of uh, Icarus sort of process. The full capitulation blow off move version of that, where we just see energy stocks crash, tech stocks go into just complete overdrive, along with the yield curve inverting effectively.
Well,
And that would be maybe, I don't know. I mean, that's where it appears that's what we're seeing.
I always think that one of an interesting take that I saw was in a UBS Global Macro note where they're talking about the potential for active managers that have been underperforming moving into those cyclicals, the underperformers, as a way of, okay, we can't catch up to um, we can't catch up to the passive investors, but maybe we could outflank them by going into some of these cyclicals, such as energy
By
or
buying
auto or
XLE.
retail or
Yeah.
XLE, of course. And that'll be an interesting dynamic to see if it can play out. Obviously, active managers are also concerned that they're trailing as much as they are. They got to justify their costs and everything to the clients, but that is an interesting take to see if we start seeing that develop. And the argument by them would be that it wouldn't be something that we'd see uh, until closer towards mid-year. So, do we see that blow off top? My question to you, Brett, would be: can you see a theme play out where we see the blow off top in a lot of these high momentum names that have been running, and eventually some profit taking that moves into those underperforming spaces
Yes, and it's what
around
I was
mid-year?
Is what I was talking about earlier. I'm kind of flirting with, positioning myself that way. And one of the reasons is I think that we've seen a relative underperformance from something like the energy sector. And then after that, we got the coronavirus situation, the, the, the turtling in terms of human movement, the massive drop in demand for fossil fuels, and the crash in crude oil back down to test levels under 50, all that happened after we'd already had a pervasive sense of underperformance on a thematic basis and a technical basis for something like the XLE. And I feel like looking around the corner, again, I think this is a situation where we are likely to see more stimulus and pent-up demand start to really play out. Um, so, I'm kind of drawn to the idea that we will see something like, if you short Microsoft and buy Exxon, you're probably going to do well over the next 3 months. I'm kind of at the point now, and again, it's a contrarian view given what we're seeing and given what we're seeing in things like options data. But it makes sense to me also from just a basic predicting the world around the next corner macro standpoint, again with a lot of extra stimulus staying in for the highest energy importer country in the world, and then seeing the release of pent-up demand as we start to see people get comfortable with the level of risk that coronavirus represents.
Right. And the areas that you'd want to be watching here are capital goods, materials, transports, energy, of course, autos, retailers. So these are some of the underperformers that we'll have to be watching. But I was amazed. I was kind of bouncing around yesterday, but I was amazed when I heard that Apple warned that when I found out that the Nasdaq closed up a point. I was definitely shocked, but it just kind of shows the Teflon move into those growth momentum names that's been so prevalent the last while. But I agree with you, Brett. I mean, keeping an eye out on that rotation is something that we're definitely going to have to keep an eye out on because probably have not reached that point yet where it's going to be a big money maker for you. But by the middle of the year, that could definitely we could start seeing that rotation finally take place. Um, Real quick, Brett, inflation catalysts according to the fund manager survey. We got modern monetary theory at number one at 26%, followed by G7 infrastructure spending at 24%. And then the third was election of a progressive liberal as U.S. president at 18%. Now, I that is I did find this interesting because kind of like what we were talking about with the risks, it's kind of a little bit broad based there with two of them running at 50% of the fear, and then you have the progressive liberal president at 18%. Now, the modern monetary theory, we've certainly seen that play out. I was kind of surprised that was number one, considering we've kind of been seeing this modern monetary theory really for the last 10 years and it hasn't played out. But then for it to be followed up by G7 infrastructure spending, which I know there's been some talk about Germany doing it, but outside of that, it doesn't seem like a realistic pathway for most countries at this point.
Well, I mean, I don't think we've seen the full version of MMT at all yet in terms of, actually coordinating the Treasury and the Fed and modeling that coordination in other countries around the world. But, there's a momentum that direction because having them independently attempt to manage their individual mandates hasn't generated inflation. And so if they coordinate and we just start handing money to people and then putting it on the Fed's balance sheet, that's going to be something that's going to be an interesting experiment. But I tend to think that again, we're at this point. We've talked about this several times. We're at this point in history, and the change of the Fed's underlying philosophy and its assumptions that I talked about earlier in terms of its pledge to not hike until they see an inflation problem. All of that kind of continues this theme of we're at a historic some kind of trough in belief by regulators, policymakers, market participants across the board in the ability for inflation to be a part of the picture at all. So strictly from a sort of contrarian point of view, that's probably a point where longer-term portfolio positioning around the idea of inflation again becoming a theme as part of our lives seems like a reasonable allocation strategy. But I don't know what the catalyst is going to be to cause a sudden. The way that the item is presented in the fund manager survey is as if there needs to be some particular thing that happens that suddenly makes inflation happen. And I think it's just, I'm not sure that I can identify with that characterization in general. I think that we've got people positioned in their lives and in financial markets as if inflation is not possible, central banks acting as if it's not, governments acting as if it's not, and data showing that it's not. And, I think that, the way the Fed's positioned itself, the way that everybody's positioning themselves, as it starts to become a thing again, people are going to be very late to react and constrain it, and that's exactly how you have the notion of there being a quote-unquote problem of inflation. So we've created the terms already for that to be the case.
All right. So, Brett, any other points from the fund managers survey that we didn't touch upon that you want to point out? Brett?
Yeah, sorry. No, I think we've covered the basics, and I think that through my notes and through our conversations and the posts that we do, we'll kind of get to some of the more details. But I think that we've seen a reduction in growth expectations and a continued ramping up and overweighting. We've seen a reduction in cash levels down kind of to the levels where we're starting to get, just in basic terms, that the fund manager survey starts to become a bearish asset or in our overall portfolio of sentiment data points. It's getting close to that, but it's not there yet. So it suggests that we're still in this process of gradually escalating kind of blow off. And I would suggest that overall, the period that we've seen over the last several months, we did a good job of identifying the likelihood of this process of professional and retail investors going from severely underweight to severely overweight in an aggressive process. That's what we've been seeing. That's not something that's going to characterize your market reality for all that much longer. It's not. It's an anomalous event. It isn't that we've just began a process of 36 months of this kind of stuff. We're seeing something that's anomalous in the broad landscape of how markets behave, and you need to deal with it properly. You need to also be ready to deal with something else around the next corner. We're getting there. We're maturing this process, and we're moving towards probably more what I would consider to be more interesting two-way market action across a number of global assets. And again, we're seeing this, so this is kind of the way that I'm trying to summarize things. We're seeing this sort of eye of the hurricane, odd mixture of different market moves, where we're seeing some traditional, what I would call the four horsemen of the apocalypse. When you see gold rallying with the dollar, with bonds, we're not really seeing the VIX yet. If that starts moving, that's everything. That's usually when things are going really wrong. And yet at the same time, we're seeing what is effectively the NASDAQ transported through a time machine from 1999. And that's a very odd collection of circumstances. And it is, I think, regardless of just being stunned by the uniqueness of that moment, I think that you could bank on it, that entire collection of corresponding circumstances is not going to be something that's going to persist for a great deal of time. So there's a shoe that's going to drop. I'm not sure what the shoe is going to be. If I had to guess, I would say that probably we're going to start to see some of the bearish trends start to peter out. And like we see with the yen today, yen diving, yen is a countercyclical hedging asset, generally speaking, as a funding currency. Maybe we're going to start to see this pullback in other assets, bonds, gold, etc., and start to see maybe a little bit of a more dramatic move higher in equities that starts to put the flower on this stem. And then we start to look for some of the more interesting dynamics, I think, for the sentiment and flow show than just kind of gauging this creeping rally every week, where we start to get to some real capitulatory dynamics and we set up some strategies to deal with that. But right now, I don't think we've seen the flower on that stem yet, and I think we're moving toward it.
All right, so there you have it. That is where we stand right now. And Brett, as always, fun talking to you about this, and we'll continue to watch this evolve. But definitely, I guess my takeaway is certainly cautious, not looking to get all bared up and shorten anything because I think that blow off top is still coming. But we're seeing that process evolve, like you said. So we'll continue to watch this play out. We'll be commenting it on the site, and obviously, if anybody's got any questions, by all means, let us know. We will be posting a replay of this up shortly this afternoon. So if anybody missed it or missed parts of what we were saying, by all means, feel free to jump in and listen to the replay. But Brett, we will talk to you soon, and thanks for the time.
You got it. Thanks, Gav.
All right.